This is a presentation that I make for the client during the protection meeting when I get to the life insurance portion. I always start out with this graphic that shows how life insurance works, and I start out with a term insurance curve. And the example here would be yearly renewable term YRT or annual renewable term ART. And I'm going to make the assumption that this client is 45 years old and wants $100,000 of protection. And so the cost of that, based on the tables, would be about $250 for that year. At age 46, the cost would be higher, and it would go up every year until the client passes away or drops the policy. As time goes by, the policy gets to be so expensive that it usually drives most clients out of the product, and very few death claims are actually paid from term insurance. Other types of popular insurance these days are either 5 or 10 or 15-year term products. And these term products are priced based on the exact same curve we're looking at, except that the insurance company actually figures out that a person's likelihood of dying in 5 or 10 or 15 or 20 years is fairly remote, and so they price the product in order to take into account the fact that most people will outlive the time period that they've chosen, and at the end of that time period, the premium goes up so high that the client typically drops it or goes in search of some other term product. The other type of product that we run into an awful lot is called universal life or variable universal life. The first distinction between the two is that universal life lets the insurance company's general account provide the funding mechanism for the side fund. When it comes to variable universal life, the insurance company lets the client choose what investment products from a group of maybe 12 or 15 of mutual fund type products that may or may not be great products to own. The example I'm going to use here is that this client at age 45 is willing to pay about $1,200 per year for $100,000 of coverage, and the expectation is that the $1,200 would just be paid every year until the client finally passes away, which generally is not the way it happens. So in our example, if the client pays the premium in year one and it's $1,200, then $250 goes to take care of the mortality charge and administrative charges, where about $950 is left over that can go into a side fund and earn some interest rate over the remaining number of years to equal a certain amount of cash value. And this keeps going on, and so as time goes by, maybe by age 55, the mortality charge is up to $450, and that means that $750 that year goes into the side fund to earn interest over the remaining years to create cash value. Now, it's important to note that in the first 10 or 15, and in some cases even 20 years, there is a surrender penalty. And that will eat up somewhere between 100% and a fraction of whatever the cash values happen to be at that point. The surrender penalty is highest in the early years. And so this continues to happen year after year until we finally get to that point in the life of this contract where the mortality charge is $1,200 that year. The client agreed to pay $1,200, so that means his cost didn't go up, but it also means that no money went into the side fund. The very next year, in this specific example that I've got, the mortality charge went to $1,284 that year. At that point, the insurance company sends a letter to the client saying, you agreed to pay $1,200 this year, but that won't allow you to keep $100,000 of coverage. So your options are you can pay us $1,284 instead of $1,200, and you can keep your $100,000 of coverage, or we can drop your $100,000 of coverage down to maybe $96,000, and you can pay $1,200 for that much insurance. But keep in mind that the next year, as the mortality charge goes up, we'll have to change this again to a lower amount. Or what most clients end up doing is they just reach into their policy's cash value. They take $84 out of the side fund, add it to the $1,200 they'd agreed to pay in the first place, and that takes care of the premium for the next year. However, the next year the premium goes up again and again, and it continues to go up, and we finally get to a point where in this particular contract, the mortality charge at age 75 is now $4,000. And that means that this client has to go into the side fund to pay $4,000. However, since he's already paying $1,200 of his own money, that means only $2,800 has to come out of the side fund. And when added to his $1,200, pays the $4,000 premium. Well, a year or two later, we may find that the cost has gotten to be so big that the cash value in the policy goes to zero. And at that point, the client either has to pay that outrageous mortality charge or let the policy lapse. And what most clients do is they let the policy lapse. This isn't the kind of insurance that we like to have our clients try to keep for the long haul. If this were universal life, what we might find is the client could have had better or worse experience than this. If the funds that they chose did better than the insurance company's general fund, then the policy might have lasted a little bit longer. Or if there had been a few bad years with those funds, the policy may have expired sooner. It's not the kind of experience we'd like for our clients to have when it comes to buying life insurance. Now, the other type of insurance that we use an awful lot is called whole life. The difference, though, is it's not going to be $1,200. In this particular example, the cost of the whole life policy is $1,500 per year. But in whole life, the mortality charge is set the day you buy the policy. And in our scenario, we're going to make the assumption that the mortality charge is set in year one, as in all whole life policies, and that charge is about $500 per year, every year for as long as the client lives. That means that $1,000 would be available to go into the side fund to create cash value every year without fail for as long as the client lives. In addition to that, the policies that we use generally pay dividends, and those dividends accumulate either as cash value or as they can accumulate an interest for a client to have in just additional cash value, or they can buy paid-up additions, which makes the policy face amount grow larger over time to keep up with inflation. So these are the options that clients have, and when it comes to helping protect our clients, the products that we generally use are going to be some form of term insurance and whole life. And the only time we use universal life is when we can't get whole life, or there's some other problem with either age or health issues.